I'd like to welcome everyone to USA Today's 19th Annual Investment Roundtable here at USA Today. The goal of the roundtable obviously is to look forward to the new year, try to get an idea of where markets are heading in 2015, and get some investment advice from some of our pros here. We have four Wall Street professionals here today, some top strategists, money managers in both stocks and bonds. I'd like to introduce across from me Savita Subramaniam. She's the head of U.S. Equity Quantity Strategy of Bank of America Merrill Lynch, which is one of the nation's biggest banks and brokerages. In her role, Savita provides market forecasts to her clients, such as where the S&P 500 may be heading in the next year. And she also provides investment advice on what sectors of the market might fare well and what might stumble in the year ahead. To my left is Rupal Bansali. She's the Chief Investment Officer of International Equities at Ariel Investments. And that's a money management firm that manages $9 billion in assets, and it's kind of known for its value investing bent. The firm's investing motto is slow and steady wins the race. Rupal manages the Ariel International Fund as well as the Ariel Global Fund. Welcome. Sitting to my right is Dan Chung. He's both the CEO and Chief Investment Officer at Alger. And Alger this year celebrated its 50th anniversary this year. Congratulations, Dan. And the Alger funds manage $22 billion and specialize in growth stock investing. And the focus of Alger's looking at companies that are undergoing, quote, positive dynamic change, growth stocks. Sitting across from me is Rick Rieder. He's the Chief Investment Officer of Fundamental Fixed Income at BlackRock, one of the world's largest money management firms. Rick oversees the firm's bond investments, and he manages a lot of money, $680 billion, that's with a B. And he manages 3 bond funds at BlackRock, including the BlackRock Total Return Fund. So let's get started. We'll start off with a general question to Savita. It's clearly that the U.S. Stock market has had another great year. It's up 12%. It's going to be the third consecutive year of double-digit gains, and that hasn't happened since the go-go 90s. And since the bull market began back in 2009, we've tripled, and we're up 200%. At the same time, there's a lot of people that say, despite the improving economy, that the bull market's getting old, and there's also the doomsayers that say this market is due for kind of a big fall. So my question to you to kick the roundtable off is the record-breaking U.S. stock market still the place to be, or is it time for investors to kind of cash in their chips and take some money off the table? What's your general outlook for the new year?
Yeah, so we're still constructive on the market. As you point out, this is a pretty old bull market. But we found that bull markets don't necessarily die of old age. They die of euphoria, everybody going all into equities, and I just don't think we're there yet. We're at a point where sentiment has improved from the very bearish levels that we saw in equities a couple of years ago, but it's still pretty tepid. I mean, the average allocation to equities right now is about 50%, which is still pretty low relative to history. Valuations are a little bit fuller at this point than they were a couple of years ago. So in short, it's a little bit less easy to be bullish on stocks than it was 2 years ago, where they were the cheapest asset class around. But today I still think that there's more of a risk of upside rather than downside. So, we're looking for, our target for 2015 is 2,200 on the S&P, which is about 6% away from where we are today. So we're not really looking for as strong a year as we've seen over the last few years, but still more upside rather than downside.
Okay, very good. Now, Rupal, you cover the international scene. Everyone knows that the U.S. stock market, after 5 years of tremendous gains, isn't necessarily the cheapest market on the face of the earth. So my question to you is, given that and the fact that U.S. stocks are all-time highs, do you think that there's opportunity and value for investors to look abroad in some foreign markets? And if so, what might those markets that offer opportunity?
I think I concur with Savita. Obviously, the markets have had a big run, including the international equity markets, just as the domestic market in the U.S. I think what investors will find value in is not so much in markets, that is the broad indices, but in picking their spots, either in stocks or sectors. So I would say that next year and possibly the year ahead is far more of a stock pickers market, and therefore active investing will play a far bigger role in driving alpha generation as opposed to sort of some of the easy money that's been made in the last couple of years. So in terms of sectors and stocks, I think Europe offers opportunity in the healthcare sector, which has sort of lagged the US healthcare sector. You've had a very big run in the biotechs in the US. And I think in Europe, that move is not matched in order of magnitude. I think that there is opportunity in emerging markets, but very selectively. I think China continues to face a slowdown, and so you want to be very careful because there are many countries in the world that are still exposed to this Chinese slowdown, whether it's Australia, it's Brazil. But that being said, as a stock picker, you're always able to find opportunity, and I would say that that's what investors should look to find, active managers making active bets.
In general, and then I'll move to Dan, do you think that that a lot of these beaten down markets, i.e. Europe, with their weak economy, and Japan's been struggling, the fact that they're so beaten down, the economies are hurting. Do they provide more upside potential than U.S.? I mean, on a relative basis, do you think you'll see outperformance, of foreign stocks versus U.S. or no?
I think you do on a local currency basis, but you should be mindful as a U.S. investor, the dollar has been very strong. And so from a dollar return perspective, I think the international currencies might prove to be a headwind. That said, again, there are specific stocks, especially multinationals, both in Europe and in Japan, that benefit from the weaker currencies. So there is a way to participate. Again, you have to pick your spots and make sure you're positioned the right way and not in the ways in which the currencies might hurt you.
Okay. Dan, we know technology has had another stellar run, and I think a lot of people are looking at the NASDAQ again. You're an excellent growth investor. What is your take? Let's assume that number one, do you think the NASDAQ, after 15 years, will finally get back to its old record high back in the heyday of 2000? And if so, what's driving that? But more importantly, what message will that new high be to the market? Will new NASDAQ high be viewed as a good news sign of market stability, healing, or will it be viewed as yet a potential another sign of another bubble that is ready to burst? I mean, what's your take, and how do you think the market will react to that?
So I think the market will, the NASDAQ in particular, will definitely test the old high, and I think it will go and beyond it. I think the message actually is a very positive one. It's kind of powerful if you think in long sweeps of time, which is that while clearly the heights it reached in the bubble, the initial phase of the internet in particular, were too fast, too early. But I find it interesting that 15 years later, I think the value in the NASDAQ is a little higher than the S&P 500, but the growth is also substantially higher. Driven, of course, by tech, but also within healthcare and consumer, which together are really 80% of the NASDAQ. I looked at the subcomponents of the NASDAQ carefully over the last couple of weeks, and there are many parts of it, including, of course, the biggest holding in it, which is Apple, which are not at all expensively valued and I think are undervalued. So I'm very confident that NASDAQ will reach new highs, and I think what the last 15 years says is that the ideas that drove the market to its highs in the first phase were not incorrect. It was simply timing. Over the last 15 years, though, these are better companies. They've built their businesses carefully. They're better managed. We, of course, have a new generation. Google wasn't part of that. Neither was Facebook. But also, for example, in the biotech area, in the pharma area, a lot of the drugs that were exciting early developments are now actually real products curing people. So
more real companies this time, real businesses, lower valuations, more based on reality at this point?
I mean, much lower valuations. The valuations back in 2000 were, I think, actually really NM, not meaningful. But depending on, you had to do some magic because a lot of the companies that drove that didn't actually have meaningful earnings at all. If you'd actually averaged them out, it would have been, unrealistic numbers. Now we're talking sort of, I think, high teens is the NASDAQ's next year forward PE.
Okay. Rick, your part of the market is going to be where people say a lot of the action will be next year. Obviously, the bond market. We're looking at a big change. Federal Reserve has not raised interest rates since 2006. Their QE program, which is the bond buying program, has already ended. So a lot of people, that stimulus was in the pipeline for a very long time. Now that the sea of liquidity is starting to move out. I mean, what's your general take? I mean, from what I've been reading, in a lot of the commentary is almost like it's Armageddon, that this first Fed rate hike, whenever it comes, is going to be the end of the financial markets as we know it. Is that overblown, or what's your general take on really what's going to happen here and how influential it will be on markets in terms of turbulence?
So I think the concept when the Fed starts moving that it's going to be a problem for markets is dramatically overblown. I think you have to put some perspective on how this Fed is going to move and where we are from a rate paradigm perspective today. You think about we're at a 0% funds rate. 0% funds rate suggests emergency conditions. We are so far from emergency conditions. You have GDP, last 2 quarters GDP over 4%. That's not emergency conditions. If you have a Fed, and so you think about where this Fed is going to go, and there are 3 ways that the Fed can move rates. It's the speed at which they move, it's the pace, and the destination. It's very important. We think they could move faster. We think they're going to move in June. I think the window is open for them to move faster than that. That being said, when they move, they're going to move to a 1% funds rate. On a historic basis, 1% is incredibly low, incredibly accommodative policy. It's not tightening, it's incredibly accommodative. Then you talk about the pace. We think they're going to go and keep it under 2% for a long time. And then I think there's a very important point. The destination where they're heading, we think, is ultimately lower than it's been historically because global growth is slow. U.S. growth will be slower than it's been historically. So we think the funds rate, what would be a neutral funds rate that historically has been 4%, is under that today. So meaning that rates should move up, the front end of the yield curve should move up, but the back end of the yield curve, long end interest rates, should stay very well contained. And that is much more important in today's markets than the front end of the yield curve. The reason why the taper tantrum last year was so devastating to markets is because it was long end interest rates that moved so much. When we start moving now, it's going to be short end interest rates that move, and the economy is much more sensitive today. Very different than 15 years ago to where long end interest rates go.
So just quickly on the taper tantrum, we know the taper tantrum was markets kind of got upset or kind of uneasy when the Fed started to extract some of the bond buying purchases, take that out of the market. The one thing I want to ask you before we move on, there is a possibility, of course, we're in a yield-starved world. People are still looking to get yield, but we all know when rates rise, there's also the possibility of bond investors perhaps suffering, negative returns. What are the odds of the possibility of people who are already looking for yield maybe getting negative returns as your number one? And number two, just explain for a general audience, how rising bond yields, ends up, hurting them in the total return package.
So that's a long set of requires a long set of answers. So there are a few things to think about. One is when we start moving, and as we talked about before, you're going to have a moderate move from the Federal Reserve. The other thing that I think is incredibly important, you've never seen in history a population globally that's aging like it is today, which means the demand for income is truly epic. We've never seen this before. You have demand, life insurance companies, pension funds that are a function of an aging population have tremendous needs for income. And then simultaneously, you have other central banks around the world, the ECB, the Bank of Japan, that are buying assets, so they're doing their own form of QE, and are going to keep interest rates down for a long time. So there's something that's very important to think about in this context. That rates will move up, but it's very hard for rates to move up that much because of this aging population, because of the need for income, because of where other central banks around the world are moving. So what happened is the yield curve, the front end of the yield curve that's being distorted.
And the front end is short-term
exactly.
rates.
So it's say 3 years and in, 5 years and in is where you'll start to see rates that'll move higher significantly. Again, exact opposite of last year, where you were taking $85 billion out of the marketplace through quantitative easing in the long end of the marketplace. Now it's going to be short-term interest rates that can move up. So let's say short-term interest rates move up and you move 50 to 75 basis points higher. The long end may only move up 25 basis points or so. So you can have, and what many investors will see in a traditional fixed income portfolio is you can have zero returns, you could have moderately negative returns, and that's certainly out there. And part of why we're big believers going into 15, you have to be flexible, be tactical about where you find your interest rate opportunities, and also look to take your interest rate risk in other parts of the world that are not growing as quickly as the U.S. is.
Another big theme that people are talking about in terms of change is you're a transition. We have one transition, as we know, the Federal Reserve is going to start withdrawing stimulus, increasing rates. And the other big topic of conversation is this whole notion of volatility or market turbulence, the ups and downs increasing, and what impact that'll have on markets. Savita, in terms of the volatility, do you agree? Do you expect greater volatility, similar to what we saw in October, which kind of scares people and takes a little fear out of the market? Do you expect more volatility? What do you think the triggers will be? And what do you think the market reaction will be? Number one, and number two, how should investors kind of deal with the volatility? Should they freak out, or is it a sign of a healthy market?
Right. Yeah. I do expect a little more volatility next year. I mean, generally, what we found is that when there's accommodative monetary policy and liquidity is being pumped into the market, volatility tends to be suppressed. And as you see liquidity withdrawn from the equity market, volatility tends to come back. Volatility is good and bad. It's normally accompanied by, sort of troubled market returns or less bullish market returns. But it is good, as Rupal pointed out. I think it's great for active managers, because what volatility does is it creates opportunities to search for real value. And one of the problems for active managers over the last few years is that volatility has been so low that the spread in performance has been quite narrow. I think with a little bit of volatility, you actually get some bigger spreads between stocks, and that creates for a much better stock picking environment. I don't think it's something to freak out about, because you've actually had positive market returns during periods where volatility was increasing. But I think the way to play it from an equity investment standpoint is you want to overweight large caps over small caps, because large caps generally weather the storm a little bit better than small caps. Also, if we're moving from a credit-driven market to the opposite of that, where liquidity is being slowly withdrawn from the market, small cap stocks, which are very credit sensitive, I think will have a tougher time generating strong returns. So the way to navigate a volatile market, I think, is to search for higher quality companies, maybe larger cap companies that are undervalued, have some cash return potential to answer that need for yield, and really look for different leadership than what we've seen over the last, let's call it 20 years or so.
Dan, there's also been a lot of concern that with the low volatility we've seen the last 2-3 years, that investors have become complacent. The market continues to climb. We've talked about the double-digit gains, and there was I was reading a report from one market strategist yesterday that says the complacency can be dangerous, because people are not prepared for some adverse market reaction, and that the longer period we go with people not being afraid of the market and thinking there's not that much risk, this strategist suggests that it's time to be cautious, because at some point, as complacency goes too far, there's a risk that markets can crater quickly as the volatility kicks in and people get fearful. Is fear an issue here in terms of how people might react?
Well, I'm not sure I agree with some of the premises of first of all, low volatility. We did have low volatility earlier in the year, and of course, there's a big flare-up both in the fall, but actually earlier in the year, in February. I think the markets have actually been fairly volatile. I think one thing to think about is that in terms of complacency, I would actually say investors have generally been averse to equities in particular, which is, of course, our specialty. And we are bottoms-up stock pickers. And you can see it, for example, in mutual fund flows. In our category of growth, and also broadly in U.S. equity flows, they've been negative for 7 out of the 8 years. But last year was actually positive. This year, again, turned negative. So, investors haven't effectively, therefore, been selling all the way up in this market. I mean, I think it's actually one of the most hated bull markets in equities of all time. And in fact, the bull market really in flows, at least, has been towards the bond market, and for reasons very well explained here by Rick. I do think it's one of the formulas for why equities can continue to outperform and surprise on the upside, because in fact, the investor apathy towards equities is whatever they say, it's demonstrable in what they've been doing.
Rupal, do you think there's been a huge, the big buyer of stocks has really been corporate America buying back shares? Do you think that continues, number one? And if that slows down, do you see an incremental buyer, from the retail investor, from foreign investors, to kind of pick up the slack? In other words, as we move forward in this bull market, where will the demand for stocks come from, and is there a potential worry that there will be a lack of demand at some point, and that prices may kind of recede due to that?
No, in fact, you touched upon a very important theme, which I think is the undersung hero of this latest equity market rally in the last couple of years. Is there's been a structural and fundamental improvement in corporate governance all over the world. Whether it is Microsoft increasing its dividends and taking some corporate action on its board, to whether it's Japan, where there's a special index being created, with better corporate governance on return on equity and paying attention to more shareholder-friendly behavior. I think that sort of reduced the risk premium, frankly, of the entire equity market worldwide. And that has not been sort of reflected, I think, in valuations. The other remarkable thing is that this fetish that people have for income has been equated as if you can only source it from the real estate or the bond markets because they are viewed as fixed income securities. There's actually a lot of income to be had in the equity markets in the form of dividends. And frankly, I would say around the world, whether it's Japan, Europe, US, across the spectrum, there is significant amount of stocks that still trade at a dividend yield way north of 3%, which is kind of the equivalent bond yield in many markets. So I would say you get the best of both worlds. There is a scarcity of growth in the world because of the demographic construct, because of where we are in the cycle, etc. But you can get the best of both worlds in equity markets, which is why, like Savita and like Dan, I'm still constructive on performance, is because you get income and you get growth in equities.
Let's talk a little bit about valuation. Do we think the U.S. stock market is overvalued now? Is it priced for perfection? Where are you on valuation, and whether or not that's going to inhibit gains going forward? Since obviously I looked at some calculations yesterday. The forward 4-quarter price to earnings ratio, the S&P 500 was north of 16 versus the long-term average, slightly south of 15. So
Right.
we're above the normal averages. I mean, to what extent will that inhibit prices going forward?
Sure. So, the equity market right now, I would call it fairly valued. Maybe a
Not
little
cheap.
bit. Not cheap, but not expensive. But what's interesting is if you dig a little deeper and you look at sectors, what's driven the market to its higher valuations are not your typical cyclical stocks. It's really the stocks that look the most like bonds. So it's your utilities, your consumer staples, your tobacco stocks. Those have re-rated significantly because we're in a world where yield is scarce, and that's been the move has been maybe a move out of bonds into equities, but into the most bond-like stocks in the market.
So when you say re-rated, you mean people are moving into kind of bond proxies and more
Exactly.
conservative stocks with higher dividend yields.
High yield.
And those valuations have increased.
Have skyrocketed.
Okay.
Exactly. So utilities, if you look at the utilities sector, it's trading at, this year it's traded at a 10 to 20% premium to the market, where it normally trades at a similar discount to the market. So we've seen a real kind of shift in preference from growth and cyclicality to just plain old, yield with no risk. I actually think that utilities could be one of the most risky sectors in the S&P 500. We're underweight utilities because it's looked like a safe place to be. It pays a high dividend yield. Meanwhile, it's got a tremendous amount of leverage. If interest rates do anything besides go down, that could show up in terms of earnings volatility. Rates moving higher makes fixed income a little bit more competitive than high yielding equities. So, I think that valuations for the market are a little bit distorted, given that the big drivers of higher multiples have been these more defensive areas. Meanwhile, if you look at technology, to Dan's point, it's actually trading at a pretty attractive relative multiple. The tech sector in the S&P is trading in line with the S&P.
So are there basically, pockets of the market now that, may be a little out of whack, but in general, the equity market is not a scary place in terms of valuations, Dan?
Well, I wouldn't say it's not a scary place. It's hard work. So we are bottoms-up stock pickers. So we typically start stock by stock, sector by sector. And I agree with Savita that technology overall looks relatively inexpensive. But there are more expensive and less expensive stocks within the sector, and it's a stock picker's job to sort them out. I mean, I would note one today, Google, well known. I mean, I think Google has some issues currently, but is an example of a very high quality company growing double digits on the top line and bottom line, under some challenge in Europe, as you know, into their business model. But nevertheless, this is a very, I think, inexpensive stock at this point. And if anyone has a longer term viewpoint on it, it's very attractive.
And I sort of echo, I think, what Dan and Savita are saying. For a value investor, tech represents value. So I think what people need to reset around is traditional value used to revolve around consumer staples and utilities. And I don't disagree with your assessment that actually has become an overvalued portion of the market, with some exceptions. But again, sectorally speaking, a lot of people have sort of chased that sector to trade at very high premiums. And on the other hand, anything that has not represented perfect visibility, like technology or even biotech, healthcare, where there's a little bit of volatility, but if you're paid to take that volatility and you can be opportunistic, there's actually a lot of value to be found in those two sectors. In my mutual funds, both the international and global equity funds, I am overweight technology and healthcare as a value investor. And I'm actually underweight utilities, exactly as Savita described, because there is simply actually a lot more risk that is not priced in.
What about prices of foreign markets relative to the U.S.? In other words, is Europe, from a valuation standpoint, more attractive than the U.S.? Is Japan more attractive from a valuation standpoint? And if they are, given their their earnings expectations or potential, are those valuations really, if they are lower, really as attractive as they appear?
Look, again, we are bottom-up stock pickers, so we look for opportunity, and as a global equity investor, I look for opportunity anywhere in the world. So for example, healthcare and technology is probably cheaper in the US, and there's less opportunity in the international markets. On the other hand, there are a significant number of multinational companies, like in the automobile sector, whether it's Toyota in Japan, or it's in financial services exchanges like Deutsche Börse in Germany, traded a significant discount to Chicago Mercantile Exchange in Chicago. So it really depends upon, where you pick your spots. There's opportunity in all parts of the world. To Dan's point, if Google is cheap in the US market, Baidu in China is very cheap as well. It's got significant growth prospects. So as an international or global equity investor, we can go anywhere in the world, whether it's the US or abroad. So we are pretty agnostic as to where we find the opportunity, as long as we do.
I mean, if I can interject. I mean, one of the interesting examples of this would be, the theories would be Pepsi. Pepsi is basically trading at 20 times forward earnings. There's a perception that staples is somehow a steady, stable, and therefore safe business. But go into any grocery store anywhere in the world, and particularly outside the US, and ask yourself, does Pepsi not really face challenges in its snacks and its beverages business? I would argue quite the contrary. I mean, the trend to healthy, non-sugary drinks is deadly to Pepsi. And the idea that what they sold here for snacks that worked 30 years ago is still working today with today's consumer and is also working over in every other country in the world. Okay, and let's compare that to Apple. Apple is trading at probably a 20% discount on an app. It's roughly 15 or 50, I think it's 15 times next year's earnings, or maybe slightly less, not accounting for all the cash that it has in its balance sheet. Apple truly has competition. Everyone recognizes that. But is it really any more or less competitive in that business than it is in Pepsi's today? And which one is growthier? There's no question on the growth scale that Apple is growing far faster than Pepsi is. It is trading at 20-25% discount to it. Great example of preference for dividends, but also a little bit of a traditionalism about thinking what is safe and what is not safe.
Let's talk a little bit about the whole notion of a bubble. It seems like everywhere you read, someone's claiming there's a bubble. There's a bubble in the bond market. The stock market's a bubble. You have doomsayers saying the market's going to crash 50%. I guess my general question is, A, do we think there's a bubble in the U.S. stock market, number one? Yes or no? And if so, what are the telltale signs of that viewpoint, or what are these doomsayers looking at in terms of that call that scares people?
Well, I think there are parts of the S&P that look bubble-like. And I would argue that those are the parts that resemble bonds the most closely. No offense to bonds, but I do think that rising interest rates and, in the U.S. economy getting better rather than worse could shift investors' preference away from defensives and these so-called safe stocks into some of the more cyclical areas of the market. So what I worry about is that the third bubble that your average retiree is facing now is this equation where they're basically equating yield, high dividend yield, with safety. I don't think that's going to be the case in the years to come, and that's where I think that there is a real danger of a real downside risk to these stocks.
Rick, what about the bond market? I mean, if there's one place that people zero in on, talking about a bubble, it's the bond market. I mean, the Fed's, poured $1 trillion into the bond market the past year. So is it a bubble, and is there a big risk that this thing potentially blows up either, I mean, what are the odds of that happening, or is it low?
Sure. So, it's interesting. I think the bond bubble story started about 5 years ago. And every year people say, and actually I think that discussion is much less today than it was 5 years ago when the 10 years at 230 yield. So I think what people have to recognize is the reason why bubbles burst is you have too much supply relative to demand. That's what blows up a bubble. You actually are running a dynamic today in interest rate and fixed income in the world where you have too much demand relative to supply. And that's actually, I don't know what the inverse of a bubble is, but you actually have a dynamic where the system is de-levering. You're creating less leverage. Europe has to de-lever, Japan has to de-lever, China has to de-lever, the US is reducing the debt in this country. So what happens is you don't produce enough fixed income assets. You don't produce enough yielding assets. So what's fooled people for a number of years, and everybody keeps saying rates are going to move much higher. Well, that would be great, but usually it happens when the supply exceeds the demand, or you have more financing that's happening. We're actually going the other way. I would throw out one other dynamic. The system in the world, one of the great risks is actually not inflation, it's deflation. And one of the things that people have become much more sensitized to recently in places like Japan or Europe, there's only one hedge, there's only one thing that works in your portfolio when inflation doesn't pick up, or actually deflation, and that's long-dated interest rates, and that's what saved people. And people were confounded this year. You look in the UK, you look in the US, how long-dated interest rates did. I was looking today, long-dated interest rates in the UK are up return are up 45% this year. If you own long-dated 30 years, they're up 45% return because of this tremendous rally.
It's like a stock market return in a huge year.
So I think people don't, listen, we think rates are going to drift higher. We think it's led by the front end of the curve. But we think we're in a low rate dynamic for a very long time. And I don't think people give that enough credit because you're easing policy in most of the world and will in 2015.
Very quickly, how high do you think the 10-year gets next year? Now it's about, it started the day 2.25. Now it's like 2.3%. I mean, does it get up to 3%, or because that was a prediction at the start of last year?
Yeah, I think it could. I mean, so if you actually run what fair value of the 10-year is, we think fair value on the 10-year is 275 to 280. So we're 45, 50 through fair value of the 10-year. However, you also have a dynamic where you have this tremendous policy around the world that's crushing JGBs. The Japanese government bond market trades at 50 basis points in 10 years. German 10 years trade at 70 basis points. The 10-year Treasury at 230 looks like a steal relative to those other markets. So that's why you've compressed down. So do we think that the 10-year could move up to 275 to fair value this year? I think so. I absolutely think so. But it's got this incredible headwind against it because the demand from every other part of the world for treasuries, which seem like the cheap asset, will continue.
Let's get back to stocks again. I mean, the big question is, will we finally get a 10% correction? I mean, we haven't had one since I believe late 2011. We've gone 3 years. We got like a 9.9% intraday correction this year.
That's right.
Is this the year that we finally get one? Number one. Number two, what will be the trigger? And I guess the flip side of the question is, will that 10% lead to perhaps a bigger decline of 20% or more, which would equate to a bear market? Do we see the ingredients for a correction next year finally? And if so, will it potentially degrade the market more seriously?
So I would note that this year actually had two major corrections in my view. First of all, in the early part of the year, from February to about April, growth stocks generally, biotech in particular, but also the cloud stocks, other tech stocks, high growth consumer, all took a very significant correction. The biotech stock index, for example, was down over 20% during that period. The market did not, because there was a strong rotation into the kind of defensives that Savita was talking about. First of all, that's a very healthy sign for equity markets that the overall market index is held up that way. I think, and then most recently in the fall, as you noted, 9.9% intraday correction. But note how quickly it recovered. I think we're going to see more of that. And I think it actually does create the conditions for stock pickers to outperform, because since some of these sell-offs, sort of ridiculous valuations, for example, in the biotech correction earlier in the year, some of the growth biotechs versus, say, the slow pharmas, corrected basically to PE levels that are exactly the same or slightly below their pharma brethren. Meanwhile, they have growth rates that are literally triple or even quadruple the drug stock. And since that time, almost all of those biotech stocks have recovered 30 to 40% and have reached new highs today as we speak. So I think that's going to continue next year. I would not be surprised to see two similar market events. Will be interesting to see is whether in one of them it's more like the early part of this year, where a defensive rotation sort of masks the underlying volatility, and I'm sure we'll have another one where we have close to 10% is going to be tested simply because investors are going to want to test it.
It's interesting, and looking at about a dozen outlooks for 2015, it seems like the general consensus is, the market can suffer some, smaller corrections, but there doesn't seem to be anyone really predicting anything catastrophic, and sometimes that worries people from a contrarian standpoint. If everyone thinks, the market's going to be up 6 to 8%, earnings are going to be 7%, everything's hunky-dory, we're going to be up 10% for an additional year. The question is, what potentially is that is out there that could create enough angst and turbulence to knock us down 20%, to have something, because the big fear still, dating back to the financial crisis and, back in 2000, is everyone thinks the next, market downturn is the next big one. So the question is it possible, and what would need to happen to get that sizable downturn? Rupal?
Well, I think,
you think
in
it's possible?
terms of anything's possible. But I think it's a question of how you take advantage of what's thrown at you rather than simply react to it with fear. So to us, volatility equals opportunity. And I think one of the big risks facing the markets is if Europe is unable to face effectively the threat of deflation that confronts it, I think that can certainly derail equity markets worldwide, because it'll raise the specter of sovereign risk all over again. And we saw what that did to equity markets, a year and a half ago. But I think that Draghi and yesterday and in the upcoming meetings, they recognize that threat. I think Japan has taught that lesson to the rest of the world. So they are taking the appropriate steps. If they fail, I think that's the tail risk to the markets. Having said that, I think, again, to answer your question about, this notion of complacency, in fact, Ariel, we pride ourselves on being contrarian investors. And, one of the ways in which I would argue that the markets have shown a very healthy underpinning to them is energy, for example, has corrected sharply in the last 6 to 8 weeks. And yet the indices have taken that in their stride, similar to what happened in the biotech sector, a few months ago, perhaps in the NASDAQ. And I think that kind of speaks to the fact that supply of equities is far less than demand for equities. Again, the same point that Rick made earlier, and that sort of underpinning that if one portion of the market faces a challenge, the money seems to go elsewhere and finds a home. I would say that in this market next year in particular, I actually think healthcare is the new staple. I think the market has not understood that or has not priced that well enough, whether it's biotech or traditional pharma. In an aging society, the demand for healthcare is going to be astronomically higher compared to the past. So that's the one sector of the market that I see significant growth. There has been such a fetish on price reimbursements, and right. Medicare and austerity and all those things, and genericization, again, hurting prices, that there has not been enough focus on volumes. volumes are going to go up a lot. And that can offset, the price pressures to create enormous revenue opportunities. So again, a stock picker's market, I think you've heard that repeatedly around this forum, and I concur with that. Whether you're a growth investor, a value investor, or a strategist, you really need to pick your spots. There's enough opportunity in the market. I think that's really the central message.
Can I throw one response on it? On what disrupts equilibrium in the markets, and I think RuPaul described it right, is we've lived in, a part of what buoys the equity markets, and we think will create a good equity market as well into next year, is what Dan was describing, the amazingly low interest rates. It's a subsidy to the equity market, and just the cash flow ends up getting to companies' equity, and I think that's underestimated by markets. The thing that would disrupt it, and I think the thing that becomes very challenging is what RuPaul said. So much of the world outside of the U.S. has largely brought down the debt, has come down. Households have come down significantly. Financial leverage has come down significantly. In Europe, the leverage is not down. In Japan, the leverage is not down. So we're living in a world of easy, very, very easy monetary policy. As RuPaul said, Draghi has to do a lot. It shouldn't all be on his shoulders. They need fiscal policy similar to what Japan is doing. But the fiscal policy has to create aggregate demand, has to create growth. If you don't create growth and it's all on the backside of monetary policy doesn't work. Monetary policy just buys you time. And if the markets get a sense for it's not working and it's just buying time to no fiscal initiatives or no real growth, then the markets will start to turn down. All the markets would start to turn down.
Any other triggers before we move on?
I think there's one other, or a couple of other triggers. So, every time we've seen another round of QE in the U.S., it's been met with a rally, but a lesser rally than the prior injection. So I think that where we are now, there is a little bit of cynicism around the idea that the central banks can basically solve all of the problems of an ailing economy. So one of the things that I think is a risk to the global markets is that we've just embarked on liquidity programs in Japan and Europe. We've seen how it took quite a long time to actually drive the economy out of its doldrums in the U.S., so that might not be enough to keep everything going, to keep the global picture afloat. And then the other key risk, I think, is oil, where we've seen a tremendous amount of volatility in oil prices. If we see further downside to oil, that could keep a lid on valuations for the S&P. So lower oil prices are good for the U.S. economy because everybody seems to spend more, but they're actually bad for the stock market because energy is a much bigger contribution to earnings. And that's where I worry, is that if we see continued oil price volatility, continued downside to crude prices, that could create October-like sell-offs that could drive the market lower rather than higher.
Can I do the silver linings playbook?
Sure.
So China and India, we haven't mentioned those two.
Which have performed super this year.
Right, and my view would be that there's a risk there if that were to, if they were to have issues in both of those economies. But actually, the silver lining playbook statement is about, I think those are actually the offset European weakness. I think both those countries can show some significant progress in the next 2 years. And the recovery there in their economic growth, particularly in China, but also in India, will be, I think, hugely significant. And note, it's not a factor you can look back in history to measure, because 20 years ago, China was irrelevant as an economy to the world financial markets, and India was essentially irrelevant. This is no longer true. Those two together are actually, in my view, more important than European plus or minus progress. And by the way, I think what Europe will give us, and I think Rick knows this, is the deflation risk is going to continue to result in active stimulus, monetary policy. It will drive, I think, exchange rates, the US dollar stronger. I think that will actually attract Europe. We haven't talked about European bond investors. I think they will be very attracted to US equities and US bonds. But from my point of view, there is risk in China and India if things go completely astray, but I think it's a silver lining and it's much more likely to go the other way.
What about politics in 2015? The Republicans now control Congress. We have a Democratic president. Do you think a GOP-controlled Congress will be bullish for stocks?
Well,
Well, I'll weigh in. I don't actually think politics matter all that much for stocks. I know that's a terrible thing to say, but we've seen the market sail through some pretty horrific events in Washington. We had the fiscal cliff, we had the government shutdown, the U.S. got downgraded, and the market just continued to perform reasonably well. So, I guess the good news or the bad news is that the S&P 500 seems to be less tethered to the White House and more tethered to corporates and what decisions they're making and how they're allocating capital. And I think that's what's driven the market far more than politicians.
Anyone disagree?
Yeah, I think for the next couple of years, you probably won't see a tremendous amount of legislation that will change the dynamics in the markets. There's certainly the potential for corporate tax reform, hard, but there's certainly potential there. There are other fiscal initiatives, obviously immigration and others that could have slight impact, but I don't think they're going to have dramatic influences. There are fiscal things to be done, and we think about in the debt markets and what's created debt in the markets, things like student loans, that you can have fiscal initiatives to help deal with some of those, what is one of the debt problems today that can be tremendously helpful. But I think net, you probably won't see a tremendous amount in the next couple of years that'll impact markets significantly.
Here's a quick question. Individual investors, follow the Dow Jones Industrial Average very closely. Do you think we get a Dow 20,000 next year that would equate to? It sounds, super high, but it only equates to, like an 11% move upwards from here. Do you think there's a possibility of Dow 20,000, and if so, what message might that send to markets? Or will it bring more investors in thinking, man, this market is just taking off? Will it take a Dow 20,000 to get retail back in?
I don't think so. I think the Dow, because it only consists of 30 stocks, and as we pointed out, I think you'll have more choice in a broader set of securities and sectors, not just in the US but abroad, to drive performance as opposed to 30 stocks. So independent of whether the Dow reaches 20,000 or not, I think investors can still look forward to making some very good gains from equities in 2015. So that's my view, at least.
Does anyone think we'll make it? And if
Yeah.
so, will we celebrate it or fear it?
I'll take a shot. I mean, I just know that it's at 15.3 times forward earnings. So of the major indices, it's one of the cheapest U.S.-oriented ones. I mean, the S&P is at 16. So I don't think, it's difficult. And of course, the Dow is dragged down right now by concerns of it is because of the constituents dragged down by the European concerns in particular. It's more globally exposed than the S&P or, for example, the NASDAQ for sure. But the multiple expansion there isn't very demanding. I haven't looked at the dividend yield. I'm assuming the dividend yield is probably quite a bit higher than actually the S&P.
Certainly higher than the S&P. I mean, I think it is a psychological draw if you see the Dow clear this hurdle. We've noticed one thing that drives inflows into equities is greed. Greed drives flows, and every year that you see better returns from a certain asset class, one could argue that you're more likely to see inflows into that asset class.
Let's talk about what could go wrong next year. Obviously, people need to know the caveats when they make decisions. Let's go around the table. What keeps you up at night? What is the one big risk that you really worry about that could really cause a cascading downward in financial markets? Dan?
I would call it rising global nationalism as a rejection of globalization and the benefits that it brings. And you see it in sort of the tensions politically around in China, in South and Asia, America's at role there. You see it in Eastern Europe, Russia, Ukraine, and of course the Middle East continues. So I think these are hotspots to be watched. And I think they're more prone to tragic responses when economies are weak, when unemployment is high, et cetera, et cetera. So I'm very concerned about that.
Rick, what keeps you up at night? Managing all that money.
So I'd say October was pretty illustrative of what can happen. And I think everybody tries to talk about what happened and I always find it interesting, people say, well, oil went down and it was a sign of global growth. But oil keeps going down and the equity markets keep ripping higher. So it wasn't oil that drove the markets down. What's happening in the markets is you're creating tremendous crowding. And everybody's doing the same thing. Everybody's long the dollar in their portfolios. Everybody's short U.S. interest rates. Everybody's long European front-end interest rates. The assumption that Draghi will do more. The key, I think, going forward, we're relying so much on easy monetary policy in Japan, now China, ECB, U.S. still accommodated despite tightening moderately. You have a dynamic, you have to create stable equilibriums in your portfolio. You have to diversify like crazy. I think people don't recognize today that if you don't create diversification, you end up being in the most crowded positions, which you think about was energy in some ways. So we believe in, think about where the opportunity set in the world is and diversify. Where do you own your interest rate risk? Where do you own your equity risk? Where do you own subordinated risk, subordinated debt risk?
So you don't want to be where everyone is right now.
Well, you don't want to be in the crowded positions, and you want to make sure you diversify, create stable equilibrium. Think about how an endowment or a foundation thinks about their portfolio. You have to have interest rate risk or interest rate cash flow coming from the right parts of the world. Take some risk where you're growing. The U.S. is growing clearly. Take some risk in that part of it, but create diversification. We run a fund that's a strategic income fund. We look to create diversification and equilibrium so you don't have this tremendous volatility in your portfolio like you saw in October. Because I mark my words, we will get more volatility like October because, and it's very, very important, when a system, you think about what happened for 20 years, you had more and more debt put on a system. And what that does is it creates more and more opportunities, debt, equity, private equity, et cetera. When the system doesn't grow that way, everybody crowds into the same positions, and you're going to get more volatility in the backside of it. So big believers, diversify, create more of an equilibrium in your portfolio.
Rupal, what's your big worry?
I actually think that the big worry is still China. I know it's been a worry for a couple of years, but I don't think that it's manifested itself in bad outcomes for a lot of sectors and companies that benefited from this Chinese growth over the last sort of 10, 15, 20 years.
Anything specifically about China that worries you? Is it the real estate overbuilding? Is it the economy slowing? Is it the transition to a more consumer, related economic driver? I mean, what specifically worries you about China? What could go wrong?
It is the real estate bubble, which is a real bubble that I know has been talked about, but it has not really burst. And I think on the back of that, what people have not appreciated enough is that debt to GDP in China has seen a massive increase as the Chinese central government has internalized on its books the problems that occurred in the private sector. So you've seen a very massive buildup of public debt to GDP in China. Everybody thinks of China as a very strong country because it has a lot of foreign exchange reserves, which is true, but its exports are slowing down. The shadow banking system has created a lot of non-performing loans, which will end up on the central bank's balance sheet, which have ended up on the central bank's balance sheet, inflating the debt to GDP. So I think that this kind of debt load always creates challenges, and especially if you don't have growth, it's a very bad setup, both for sectors exposed to it. I mean, you've already seen it. I think the sector that's going to be worst affected by it is luxury goods. They have disproportionately benefited from Chinese consumer spending, and frankly inflated spending, whether it's BMWs or it's Pradas. And so I think that's a sector I would avoid. And I think China still remains the big swing factor in terms of outlook for global GDP growth and risk.
I guess, yeah.
Let's finish up, Savita, on
the risks.
One thing that people should worry about for next year.
So, I think everyone made great points, and I worry about all of it. But going back to the U.S., I think the one issue is if corporations go back into bunker mode and stop spending. So I think the great thing about 2014 was that companies actually started spending again. There was more M&A activity. There was actually a pretty sizable pickup in CapEx. CapEx growth went from de minimis to about 8% this year, which is a big boon to the economy. If corporations lose confidence in the economic recovery or go back into savings mode, that I think could hurt what we've seen as a little bit of momentum in the U.S. economy.
Okay.
Can I note the silver lining there?
Sure, and then we'll...
Most of the flows in equities have gone towards international and emerging markets, as U.S. equities have had negative flows for 7 out of the 8 years. Trouble in all of those regions actually ends up often coming back to the safe haven. And the U.S. economy is performing very well. And while we can't be completely insulated, there are certain large sectors of it that are quite insulated. And I agree very much with RuPaul. Healthcare is one of our largest overweights. That is one of the most insulated sectors, not only in the U.S., but actually we are a leader globally in terms of exporting our healthcare. So the silver lining is, although my risks are risks, some of them will probably redound to a U.S. equity market outperformance.
Well, now we're going to move on to the fun part and get some ideas of where you should put your money next year. We'll take a look at some stock picks and some investment themes for the new year. We'll start with Dan Chung of Alger.
So our picks are, first, Grubhub. This is a leading online food ordering website for delivery food. It includes and owns the Seamless brand as well. It's very popular. This is a company growing 50% this year. We see 40% growth next year. Earnings are growing at 77%, and we think 30 to 50% for several years to come. We think it plays directly into sort of the kind of changes that internet companies are bringing to very old businesses, in this case, at-home food delivery. Second pick, Tenet Healthcare Corp. We like the healthcare sector. It's one of our largest overweights. Tenet is a leading hospital operator. Currently, the main issue with Tenet has been the background of improving utilization and visits because of the Affordable Care Act has been helping the business, reducing unpaid admissions and services. However, there is an overhang caused by the Supreme Court taking a case that will review certain provisions of state versus federal exchanges. We think that is a non-issue because regardless of the Supreme Court's decision, which will probably come in May or June, the underlying fundamentals of the market are improving, and Tenet is poised very well to benefit. This is a very inexpensive stock, like most of the hospital sector, but it's a true what we call life cycle change, in that hospitals, a very, very bad business, has become actually a very, very good one, we think, under the Affordable Care Act. Symbol THC. Third stock, Blackstone Group. Sorry, apologies to Rick. BX, but in a similar vein, we like the life cycle change within financial services. In particular, private equity firms seem to have filled the gap where many banks have had to withdraw, in particular from intermediate debt financing and other kinds of refinancing and lending. Blackstone is also very active in the real estate market, we think is quite interesting. But the most important thing is essentially this is an asset manager. It's a leading global asset manager. And Blackstone is a really not valued, we think, correctly. When you typically look at the typical asset managers, also find companies like BlackRock, T. Rowe, you're often talking about double-digit PEs. The private equity companies, on the other hand, are newer to the public markets. They came public at a bad time. Many of them, their stocks suffered. And so they're still trading at single-digit multiples. And we think this is a misvaluation of what is actually a very fine asset management business, so Blackstone BX. Within technology, again, a top sector for us. And an example I bring, we like many of the growth stocks in the sector, but Micron Technology is an old name. And interestingly, is a combination of solid growth, excellent market position. The biggest life cycle change that's occurred in this industry is that the top 5 players in computer memory, DRAMs and also NAND memory, are now representing about 90% of the global market. This used to be a highly competitive, almost irrational market 10, 20 years ago. Today, it's actually a global oligopoly with the top players really very focused, and we see this across many companies, focused on delivering better profits, better returns to shareholders. And so we see double-digit growth on the top line for Micron and an improving background for NAND flash in particular, but also DRAM. Good profitability. The company trades at only 8 times next year's earnings, and we see earnings growing over 20%. Micron MU. And then finally, SunEdison, SUNE. We are a growth manager, and we're always looking at what the highest growth sectors of our markets are, and SunEdison plays directly into one of them, which is solar energy. So SunEdison is a developer and operator of commercial and utility scale solar projects globally. We believe that solar power generation will continue to grow against the backdrop of, first and most important, solar power is reaching and has reached grid parity. In other words, pricing for solar power has reached equivalence with electricity generated from other sources in some regions, and we think it will continue to make progress toward reaching that goal over the next 3 to 5 years. So even without the subsidies that many attack in this area, solar is a leading growth vehicle, we think, within the energy space, and SunEdison, we think, is one of the companies extremely well positioned to capture this, both in the U.S., which is about half of its business, and also globally, where it has business in Asia and also Latin America. a very high growth company, we think, with a lot of attractive upside. We see a CAGR within the solar industry that exceeds 70% actually over the next couple of years. It will slow, of course. Eventually those numbers are not sustainable, but it's just an example of a transformation, we think, in terms of the energy industry and forward technology.
Thank you, Dan. Rupal, what do you like next year?
Sure. Look, in line with sort of our theme of value investing and being contrarian, almost all of my top 5 stock picks that you will hear about are names that are not sort of market favorites, but I think that they will be, and that's sort of the goal, to buy the blue chips of tomorrow, not of yesterday. So one such name is GlaxoSmithKline. Ticker is GSKUS. It's coming in the ADR form. It's a UK listed company. Its core franchise is in respiratory therapies, in particular asthma and COPD. And one of the things that people are not aware of is that actually pollution and sort of respiratory diseases are growing even faster worldwide than diabetes. And Glaxo is squarely positioned in that platform, and I think is a key beneficiary of that sort of trend. It's a misunderstood company because its new drug launches have not fared very well, and they faced a certain generic threat in their core franchise of Advair, but that's about to pass sometime in 2015. In the meantime, because of that transition in earnings, where they're not actually going to report growth till 2016, you can buy a stock on 13 times earnings and a 6% dividend yield. So you can clip a coupon while you wait for the growth to arrive. And that's sort of the classic kind of investment opportunity we look for, almost a combination of growth and value that you don't have to pay up for. My second stock pick, and again, like many of the themes that I mentioned in our conversation before, they're quite uncorrelated with each other. You have to pick your spots. So the second stock is in the financial services industry, actually a German security, Deutsche Börse, ticker symbol DB1, space GR. And this is a company that really specializes in clearing of derivatives. And as you know, a lot of the prop trading and derivatives transactions that used to go through banks or required to go through exchanges, that initiative, that regulatory reform is kicking in next year and the years to come, and they're a beneficiary of that. Now, just like I mentioned, there are some international stocks that traded a huge discount to the US counterparts. Deutsche Börse trades on 15 times earnings with a 4% dividend yield, compared to, say, Chicago Mercantile Exchange in Chicago, which trades on 22 times earnings. So here's an opportunity that you can arbitrage. My third stock pick is actually a name that is pretty household, and yet a name that is pretty much hated, not of late, but historically, Microsoft. That, of course, is MSFT space US in the US markets, a technology company, one sector that I mentioned to you we are overweight and we like old technology quite a lot. This is a stock that used to trade on 50 times earnings, back in the NASDAQ bubble days 15 years ago. Today has come down to a valuation of 13 times. And for perspective, the notion that the market seems to price into Microsoft stock is that the success of Apple comes at the expense of Microsoft. And that is not true. Apple is predominantly a consumer company. Microsoft is predominantly an enterprise company. And the two can succeed independently of each other. But that creates the opportunity in the market because it's misunderstood and mispriced. You can buy the stock on a cash-adjusted P multiple of single digits, when the S&P 500 is trading, as you know, mid-teens. And this is a company that will report close to $100 billion of cash, net cash on its balance sheet, on a market capitalization of $400 billion. And every year it generates free cash flows that can be distributed back to shareholders in the form of dividends or share buybacks north of $25 billion a year. So that is the power of getting, again, income and growth in the context of a Microsoft. My fourth stock pick is in a market that I don't like a lot, but as I said, you can always find opportunity even in bad neighborhoods. And that stock is in the telecommunications sector, specifically wireless telcos, which I think we'll all agree cell phones are the new staple as well in our lives. And smartphones are leading the way of utilization. China Mobile is a pure play wireless telephone company in China. It has the largest subscriber base of any consumer company in the world, 700 million plus subscribers of their services in China. They had a setback in the last couple of years because the government had forced them to adopt a technological standard that actually created a headwind for their adoption rate. In the next generation of 4G, they're deploying a new network, and they'll be able to launch smartphones that will have a much better take-up rate. And in fact, the iPhone will also be launched on that network. And so what was a handicap in the past is actually going to become a tailwind for them in the coming years. Because the stock's past earnings growth has been very lackluster, the stock is trading on a cheap multiple of 12 times with a 3.5% dividend yield. So again, the ticker on China Mobile is CHL space US, and it's something that you can own in ADR form or locally in Hong Kong. My last stock pick is really a small cap company that I think represents a lot of value despite having a lot of growth prospects to it, and that is Tumi. If you go to the business class or first class compartment of any airline flight that you take, almost half the travelers will sport a Tumi bag. In fact, their briefcases, one that I see right across the table from you, and Dan, I guess, is a Tumi fan just as I am. And Barack Obama, all right, we are in good company. So Tumi is a company that listed only 2 years ago, so it's still below the radar of most investors. If an investor has missed out on growth stocks, which had secular growth prospects, like a Starbucks in its heyday, when it wasn't in its heyday, Tumi is possibly the same sort of early innings of its success story, where it's going to expand its retail footprint. A third of its sales came from the New York area. So it's got tremendous expansion potential in the rest of the US and also abroad. It fits the definition of our investment style at Ariel, which I like to call quality at the right price. Well, Tumi is affordable quality. And they've just launched a new line of collections, in terms of the Alpha collection. They're also expanding, both serving not just men, which have been their traditional audience, but also women. And as an executive business person, I can tell you women have been underserved in this category. And so there's a lot of good products. So you can buy the product, you can buy the stock. TUMI US, that was my final stock pick, all of which happen to be stocks that I own personally and my fund owns in the top 10 holdings.
Very good. Interesting. Savita, what are some of the investments that you see as having some upside potential next year?
Sure. 2015, our themes are pretty simple. So I'll give you 4 themes and then 1 stock pick. First, large caps over small caps. This year, we've seen large caps dramatically outperform small caps, and there is a tendency to want to fade that because small caps tend to have outperformed for the last couple of decades.
Fade that as in to change that
Buy
strategy.
small, sell large. We disagree. We think that large caps are going to retain their leadership position. The key reason is the fact that we are at the end of a credit expansion cycle and arguably at the beginning of a credit contraction cycle. So small caps have had a tailwind of cheap capital. Smaller companies need capital to survive, so we generally see those companies struggling a bit more to raise capital. Our favorite sector is technology, and here I would say I prefer old technology to new technology. Old tech companies, these are your Microsofts, your Apples, your IBMs, and your Intels. They're undervalued. They've got very, very healthy balance sheets. They've finally realized that they can return cash without the penalty of being ex-growth. So they're turning into very interesting cash distribution vehicles, which I think still matters in a low interest rate world that we will probably continue to find ourselves in for the foreseeable future. And it is the only sector out of all 10 sectors in the S&P 500 with net cash, more cash than debt. Least favorite sector, consumer discretionary. And here I see a lot of headwinds for the U.S. consumer. One, the demographic story. As other panelists have pointed out, populations in most developed markets are getting older. Older spenders tend to spend more on healthcare and less on cars, clothes, and typical discretionary items. And we think that that's a longer-term tailwind for the consumption, or longer-term headwind for the consumption sectors. Consumer discretionary is one of the most crowded sectors in the S&P 500. It is the most consensus overweight by mutual fund managers that in the large cap US space. So there's a lot more selling pressure than buying pressure. Margins are at peak levels, but with the Fed basically backstopping labor inflation and telling us that they want to see wage inflation, we think that consumer stocks could actually suffer rather than benefit from wage inflation, given that the consumer discretionary sector sector is one of the most labor-intensive sectors of the S&P 500. Hotels, restaurants, big retailers tend to have much more of a cost hit rather than a sales benefit from rising wage pressure. And then finally, I think consumer stocks are sort of the leadership of an early cycle phase of the market where the Fed is aggressively easing and trying to stimulate consumption. With the Fed signaling that they're done and being more likely to tighten next year, we think that that is the end of the heyday for the consumer stocks. Fourth theme is something that I alluded to earlier. We like dividend growth companies over high dividend yield companies. And here, this is a theme where, surprisingly, dividend growth stocks have been the only consistent outperforming strategy over the last 6 years since the credit crisis. High dividend yielders have done well in certain years, have done poorly in other years, depending on what interest rates we're doing. But I think the world is looking for income that is likely to grow rather than shrink, and that's where we think that dividend growers are likely to outperform their high yield, high payout ratio counterparts. Finally, one stock pick, and it's actually in a sector where we are equal weight. We're neutral on the sector, and this is within energy. And this is really a contrarian pick as well. So my top pick within energy where we are equal weight is Exxon. And Exxon, everybody knows the stock. It's a big, sleepy company, doesn't do a whole lot. The reason I like it, it pays a 3% dividend yield. It's got a low payout ratio. It's turning free cash flow positive after a long period of time of negative cash flow. It is the most hated buy-rated stock by active managers. Your average mutual fund has a 70% underweight in Exxon. So not a whole lot of selling pressure from the active community. And arguably, if we are in for more oil price volatility, Exxon doesn't move relative to crude prices. It tends to be, it's like the Titanic. It just kind of sails through a lot of volatility. It could be a good plug and play exposure to energy without shouldering a lot of the oil price volatility. And those are my 5 ideas.
Brooke, any advice to bond market investors next year?
Yeah, the key to investing in fixed income is the reason why people invest in fixed income is how do you create stable income? How do you generate, and where rates are today, there's no home runs to hit in the fixed income market. How do I keep generating stable return and around the dynamics that are happening in the world today? So we'll start in the U.S. One of the areas that during the taper tantrum took on the most pressure is one we've been recommending for the last year and still believe that it'll do well is long-dated municipals. Long-dated municipals are still in a dynamic. So when we think about when the Fed moves, the Fed's going to move the front end. We talked about during the taper, they moved the back, the longer end interest rate, longer end of the interest rate curve. Now they're going to move the front end. The long interest rates will hold in well. You can buy long-dated munis behind 3% on a tax-adjusted basis for an individual investor. You're still clipping, depending on state you live in, you can clip 7 to 8% return, 7 to 8% yield. You think about long-dated munis, and as long as you hold them for 3 years, 4 years, 5 years, you're still generating a significant return, and that yield will work for you over a period of time. And again, as long as you believe that rates aren't going to rocket higher in the U.S., and there's no way the Federal Reserve is going to allow rates to move dramatically higher over the next couple of years. So we like long-dated munis to start. Places like transportation, healthcare make a tremendous amount of sense that we think. Also,
so when you say long-dated paper, you're referring to 10 years?
10 years, 10 to 30 years. Okay. And again, we think people will be surprised like they were this year by how flat the yield curve will meaning how long-end interest rates will do well relative to shorter interest rates. Second part of the marketplace has been a tremendous movement into high yield, into the junk bond market over the last couple of years. High yield will probably continue to do its job. Default rates will stay low. However, it's not one of my picks. I actually think it'll do its job. I think commercial mortgages, when you go back and think about what this cycle is going to be relative to where we were 10, 15 years ago, the place that was levered 10 to 15 years ago was real estate. Where that debt was put on was real estate, mortgages, commercial mortgages, residential mortgages in a series of ways. You're actually not levering, you're not creating that much debt onto those entities today. The supply of commercial mortgages is not going to be that significant. Where investors have come in to the market has been in high yield, and we think, and we talked about earlier, crowding into some markets. We'd rather go to another place. Commercial mortgage, you could buy the same debt oftentimes and have collateral underneath you and create significant yield behind you. So we like the commercial mortgage market. Again, you have to be tactical about where you get it, but you find properties today that are very interesting that you can pick up nice yields on with not a tremendous amount of debt attached to it. Then I think you have to go around the world and think about where there's opportunity in other parts of the world. Two places that we like quite a bit are Mexico and India. India has, and we talked about this earlier, a place where you have reform in place, you have a new president in place, you actually have inflation that we think will dull over time. That's starting to come down over time. And you can actually buy India, local rates in India behind 8%, just behind 8% today. And you think about where in the world policy has been aggressive. You think about in the ECB, what Europe is doing, 10-year Italy is inside of 2%. If you take the leverage characteristics of India or Mexico relative to Italy, you realize you're actually in a much more stable place, being in Mexico and in India and picking up dramatically more yield. Italy just benefits by you have incredibly easy policy. So we like, Mexico, you can buy in 10 years at behind 6%. India, you could buy behind 8%. And again, we think creates this global diversification into your portfolio. Last point I would make is in Europe, and one of the few places that we like to take some of the debt risk in Europe is bank capital or subordinated debt or capital that's coming into the marketplace in the banking system. You think about what Europe has to do for the next number of years is recapitalize your banking system, bring down the leverage, bring down the size of the asset base, and create a higher capitalization to that structure. So what happens is the banks are issuing capital and subordinated debt at pretty attractive levels, and we think that's a great way to play Europe and get some significant yield in an environment where policy is incredibly easy and pushing yields down. So net, we think diversify, think about where rates are going to stay stable in the world or potentially decline, and be on the right parts of the yield curve in places like the U.S. where rates are going to gradually increase.
Very good. Well, that concludes this roundtable. We're hoping that investors got some good ideas for next year's investments, and we wish everyone a good investing year in 2015.